Hello and welcome to the EconBuff podcast. I'm your host, Lee Stitzel. With me today is Dr. Ryan Mattson, professor of economics at West Texas A&M University. Ryan, welcome.
Thanks, Lee. It's great to be back.
So our topic today is the GameStop short squeeze, and specifically the narratives that surround what the RobinHood trading app did. Ryan, just start us with a little quick, brief summary of everything that happened so that we can get into these narratives.
So the kind of story that's floating around at this point is that you had this GameStop brick and mortar video game retailer whose stock is valued to drop. So you have people doing short sells on this. And these internet investors from the popular social media forum Reddit, specifically Wall Street Bets, decided that they were going to buy into this. This was identified by a user, almost in the same way that when Michael Lewis talks about the Big Short, that Dr. Burry had identified a potential weakness in the mortgage-backed security markets. So they bought this up. It's driving up price. We see GameStop price going up from $15 to $200 to $400, back down to $100. And there seems to be this kind of story going of, you buy into this and you hold so that you can hurt some of the hedge funds that are trying to short this stock, that, they're going after these people who are hurting brick and mortar retail businesses by this vulture capitalism idea of profiting off of their demise.
So before we get going, strike one for free markets, yes or no here?
I'd say no, but
okay.
But we'll see. We'll see how it turns out.
We'll hold that. Well, yeah, that's an excellent point. We do want to remember we're in the middle of this, so there's a lot more coming down the pipeline, which is why I actually think it's an opportune time to talk about the narrative version about this. So I think you and I are inspired by Robert Shiller's work. I'm going to leave some of that for later on in the podcast, but this idea that narratives matter, and I'll ask you about the details of that later. But so you've set us up nicely here, and now I want to propose to you and have you explain to us these four different narratives, these explanations of why Robinhood did what it did in terms of clamping down on the trading. So start us with just a little bit of detail there as to how is it, what are the actual actions that they did in terms of stopping the trading, and what are some of the features there?
So the facts of the case are a lot of these retail investors, so if you think of an individual person buying an individual stock, they're the retail investors, are using an app like Robinhood to make a lot of trades or day trading using their phone, and they then buy the stock through this. As the prices started climbing almost exponentially, and at the point where I believe at the point where GameStop reached about $300, $400 a stock, Robinhood stopped all trades on GME, GME being the sign for GameStop, sorry. And then over the next few days began to lighten up, allow people to trade one share to a couple of shares. And now I think they're at 20 shares as we're recording this, which those are the facts at that point. They did this. Now the question becomes, you have a lot of the retail investors on Reddit who are looking at this and screaming bloody murder because the timing looks really, really suspect. It's at this point where these hedge funds, these institutional investors who are spending a lot of money or putting a lot of money into these shorts are trying to extend those short positions so they don't lose on the difference in value from, going from expecting a price to be at 15 to now paying it almost like 300, 400 for it. So the retail investors are seeing this as kind of a form of cheating. There's a couple narratives with it. So we want to kind of break down the different stories that are coming out. The first one I think that you wanted to get into is the mechanical issues.
Let me jump in there just a little bit, because you've set us up. That's like a perfect preview of what it is that we're going to do. And so I want to start with like the most benign version, that there are mechanical reasons that these trades end up getting stopped and Robinhood takes it on. Before we go there, my understanding was they also did where they just capped the purchases but allowed the sells of it, right? So that's also a factor here, which I think is going to come in more importantly for
Right.
for one of our narratives that we're getting down the road, which you've already teased, which is
Mhm.
there's a lot going on here, and that's why I want to give the listeners a framework for. So
Mhm.
it could be that this is completely mechanical, it's very benign. What's that version of the story as to why Robinhood did what they did?
So that version would be what Robinhood put up on their blog, and what's generally being put out on CNBC and other media sources. When a firm like Robinhood for retail or institutional investing needs to make these trades, they need to go to a clearinghouse. So what they do is that they have to verify these sales and put up a certain amount of collateral at about 10 a.m. Eastern time, something like that. So Robinhood, in order to make a whole lot of these buys, I should say, these buys into GameStop, had to go to a clearinghouse as the NSCC clearinghouse, which is owned by the Depository Trust and I can never remember acronyms, but it's the DTTC. They do a lot of stuff with overnight repurchase agreements and collateral. So they went to their clearinghouse and they said, we have all these buys for GameStop. And the clearinghouse said, wonderful, fantastic, we'd love to do it. You need to put down $3 billion as collateral. To which Robinhood said, what? And 3 billion is kind of hard to come by. So as this mechanical story goes, they don't have the collateral to put up for these trades, for these buys that their retail investors want to make. So they end up negotiating down to about 1.5 billion in collateral. And there's this kind of cooling off period that goes with it, that they can't make these buys yet. And this is where your distinction of buy versus sell comes in, because for a buy, they'll have to deposit, I believe for a sell, they'll have to withdraw. So the sell side should be fine, but it's this depositing of the 3 billion in collateral. There's nothing Robinhood can do about that, right? Because the clearinghouse is asking them for this collateral, and they just can't make those trades yet, so they'll have to wait.
So there is a version of the story where it's just literally like a cash flow issue for Robinhood. We just can't front these. So I think listeners are going to ask, wait a minute, this is happening online and this is all digital dollars. Like why does this have to be a constraint? And I think that stems from maybe a misunderstanding of what's happening in these markets, that this is like all monopoly money or something, and money that's digital isn't real or something like that. So give us a brief comment on that before we turn to the next narrative.
So with this cash flow example, we kind of still have this almost 1970s, 1980s view of, if you think of a checking account. I write a check, from my bank at Amarillo National Bank to your bank at Commerce Bank in Kansas City. And my check is then cleared by the Dallas Fed, which then clears it with the Kansas City Fed. And there's that kind of stretch of time. And isn't it wonderful that we now have this digital program that can instantaneously do that with debit cards? We can do this with credit cards. So why not with stocks? Well, there's a lot of this issue of regulation of what you need to put up as collateral, so that if something horrible happens, if 2007, 2008 happens again, then there's a certain amount of collateral to pay for that. So it may not be this kind of mechanistic issue, but there definitely is. You've got to go to the clearinghouse, you've got to put up your money, and then you can make the trade.
Okay, so I'm going to turn to our next narrative, which is, there is this potential analogy. Anybody who's listening to this has heard the word volatility so many times that their eyes bleed now. But there is this idea in stock market. So the New York Stock Exchange has these trading curves, this circuit breaker approach. Talk to us a little bit about how that might have played a role here, where Robinhood is just throwing the breaker to try to stop. Now, it's a little bit weird. So give us a sense too of why the stock market would do that, and how that is both similar and dissimilar from what Robinhood did.
Well, so let's go back to 2010. We have a nearly $1 trillion stock market loss in the space of almost just a few minutes. It's called the flash crash. And this was blamed on algorithmic trading, on traders, utilizing different programs that just went haywire. And so like if your modem goes out, what do? You unplug it, plug it back in, and it comes back. So this is kind of that idea of the circuit breaker. If there's too much buying or too much selling and the animal spirits are getting too great, or the mathematical algorithms are not reading reality right, then we shut down the stock market, as we did in May of 2010. So the second narrative then is from Robinhood's perspective, which they haven't, Robinhood themselves haven't put this up. They put up the mechanical, but this is another potential one where they thought, okay, if we let these buys go through, we may be seen as responsible for the poor decisions of all of these individuals, and then we're going to end up getting, oh, sorry, I'm skipping ahead to regulatory threat. Let me back up a second here. No, forget that.
Those are related,
yeah,
and so
those are related. So
I don't
want
want you to I don't want you
right.
to sort of feel like you have to separate those things.
Sure.
I just wanted this sense of you.
But
I like the way
let
you
me go
set
back
it up.
to the trades then. So
Go ahead.
Without the regulation, excuse me, all these trades are being made. It's a whole lot of volatility in the system, and maybe they can't handle it. Maybe their retail investors can't handle it, and things are just going too haywire. Everybody needs to calm down. Everyone needs to cool off and take a second, and let's all think like adults, and stay off of internet forums, and go back to fundamentals trading, right? So a cool off period, right? Okay, so we take 24, 48 hours for investors to cool down, and then they'll make better decisions.
Reduction I like that a lot. And I think that brings up a couple of interesting things that would be good to comment on. One is you're talking about the circuit breaker effect and having to cool off. And that's literally a circuit breaker to try to disconnect the trader's mind from the activity that's happening in the market. And I think that gives rise to this idea. And I think our listeners would be right in questioning, how do we have this gigantic financial system? How do we have numbers being thrown around like $12 billion that are just hard to even fathom? Mm-hmm. And it can be subject to something like a flash crash. It can be subject to something like animal spirits, and we might need a trading curb, a circuit breaker, mm-hmm. to shut these people off. Like, is that fundamentally human nature that we get in this frenzy of trading and we get spooked by things? Or is it something fundamental to the financial system? Is it the interplay between those things? Talk to us about that just a little bit.
I think it's just how we value these things. And I think Bob Schiller in Irrational Exuberance has a very good explanation for how bubbles can potentially form based on how people are perceiving prices. If you think that price is going to keep going up, you want to jump in while that price is going up, and you want to get out before it goes down. You can go the opposite that way too. If we're all expecting it to go down, then we all kind of want to get out, and this becomes a self-fulfilling prophecy. We may lose touch with the price signal. If markets are efficient and competitive, then the price signal should be telling us everything we need to know about GameStop's value. GameStop is worth $16 per share. But then if you suddenly have 100,000 people saying, no, we think it's worth $25 a share, then you're going to have 200,000 people noticing the 100,000 people and saying, well, they're buying. That's going to go up. The price signal is sending a very, instead of a fundamental signal, a very exuberant signal. I was going to say a bubbly signal, but maybe not even a bubbly signal, but just an exuberant signal that we have somehow, maybe we were wrong with 16, maybe 25 is correct. And maybe investors see it going up to 100 and saying, well, even if I bought at 16, it comes back down to 25, I'm still, coming out ahead from 16 as it is. So we trust the price signal in a lot of markets to give us the information we need. And in this kind of exuberant situation, the price signal is saying something different.
There's a lot to be intuit that. There's a lot to be said here, and I think you could comment more in a moment on how financial markets and stock markets might work in this regard. But there's a famous story. I wish I could remember who it was that used this example first. But if you were on a road trip, you're driving down the highway, there's two diners right next to each other, and you pull up, you're hungry, it's dinner time, and all the cars are parked at diner A, and none of the cars are parked at diner B. Where are you going? Right? There's that information. There's this idea that other people have access to something that you don't know, and there's some wisdom in that, right? And it's also this idea that if you and I are farmers and our land are next to each other, and I see your crops are doing better than mine, It's because you know something that I don't know. And financial markets are sort of weirdly predicated on that type of thing. The price is going up because people are buying it. That means they must know something I don't know, right? I wasn't a part of Wall Street Bets before this. So Wall Street Bets must know something about GameStop that I don't know. And yet it's sort of akin to that in a weird, I don't want to say perverse way, but in a way that's harder to understand, because there's some truth to that at the diner. There's some truth to that if my neighbor's crops are growing better than mine. He figured something else out that I haven't figured out. But because of this animal spirits idea, going back to the trading curb, that may not always be true in the market, and the self-fulfilling prophecy thing becomes much stronger. Why is that?
Well, part of that is, I mean, and the thing with animal spirits and the Keynesian argument is, you know, as Keynes would say, you know, the markets can stay irrational longer than you can stay solvent. At some point, the fundamentals of what these companies are worth and what these pieces of paper are worth are going to come down to some kind of fundamental price signal that is not at $120 or $90, but is probably more likely at $12 or $13 or $14. And that's based on all of these trades back and forth of consumers and firms or these financial agents who are demanding stock and supplying stock back and forth. And that goes back to kind of Smith's invisible hand. There will be a pressure on GameStop to push back down. As I think we've seen today, I haven't checked right off the bat, but if I'm looking at this, we're at 106, which is a bounce up from, I think, this morning. But in terms of 5 days, on Tuesday, it was at 115. It was at 232 on Monday. There is a pressure of this to go down because people are going to want to sell off at some point. If you bought in as it was going up and maybe you didn't sell at 400, let's say you bought in at 50. And okay, you missed your chance to sell at 400. There's going to be a lot of pressure to go ahead and sell at that 200 or that 100 or that 70 so that you don't lose out. Of course, there's the other possibility that you're holding on to it for completely different reasons, which I think we'll go into later, right?
Yeah. So I think what's interesting about that is you've actually hit on, I sort of somewhat tongue-in-cheek opened this talking about, okay, strike one for free markets, because I had a sort of a longer run thought here, which maybe I'll hold on to for a minute because I think we're gonna get to that. Except it's interesting now that you brought that up, because we understand GameStop stock just can't be $400. Like, there are correct market pressures going the right direction, and this irrational exuberance, or just, we can talk about the motives for the people that did this kind of thing, that doesn't overpower the market, right? I think there is kind of a false comparison where the market must always be perfectly right at all times, and this kind of episode lays the groundwork for saying the market doesn't work. But 2 weeks from now, we're going to look, and GameStop stock is going to be exactly priced where it should be.
And what's the market saying right now with the price? The price going up, it's a different price signal. We're not getting a price signal based on, say, the supply of the stock or the fundamentals of it or the return. We're getting it based off of demand. And you can have demand for whatever reason. You could have demand because you want to, I don't know, you like a stock, you want to buy a stock. Or you want to purchase a stock because you feel you're sticking it to the man somehow. All the price signal is giving us is demonstrating that when there's a demand increase, price goes up, which is micro 101. So I think that, I talk a lot about efficient price signals and what the price is going to give us. And I think maybe, I'm being too ambiguous with saying the price signal is I might have said wrong before, inefficient, but really, I mean, it isn't. It's the question of why are they buying it? What is demand doing to this price, which is still well within competitive markets and free markets.
So we've covered a benign explanation. It's mechanical. It has to do with clearinghouses. It has to do with collateral.
Yeah.
We've covered sort of a related idea with trading curbs and circuit
Volatility.
breakers, animal spirits, that kind of thing. Now let's get to that regulatory threat idea. This idea that
Sure.
Robinhood is looking into the future, and they won't say this, you know, but the executives are sitting around the table as this is happening in real time and going, okay, option A, let it play. Option B, shut it down. Let's think about what the long-term consequences are. And we would be quick to observe some of that is going to have to do with the threat of what type of regulation is coming out of this. Lay that kind of thought process for the executives at Robinhood out.
So let's throw in the mechanism and the volatility. We see all that happening. And I'm at Robinhood and I'm saying to myself, oh my gosh, if this keeps going, I'm going to have, everyone's going to be posting about how their brother-in-law lost, thousands of dollars of their life savings and their kids are starving. And we're the ones that facilitated these bad investments by all of these people on Reddit, these retail investors on Reddit. And then you're going to have these firms, potentially these hedge funds going out of business and then blaming it also on you because you facilitated the mob coming in, and you're going to get your rear end dragged in front of Congress and grilled by a bunch of congressmen who are not going to be very polite and are going to make tons of threats on certain regulations that are going to be placed on you and your business in the future. So it may be it may be a good idea to go ahead and say, you know what, I'm going to take all the flack from the press and people online about, oh, they stopped trading at this particular time because I may face a regulatory threat in the future. I don't know what Congress is going to do. I don't know what Janet Yellen or Jay Powell are going to do. And I may want to stop this crazy thing before it goes any further.
So a take your lumps now kind of idea.
Yes. Mm-hmm. Yeah.
So, you mentioned along the way this idea of people getting in and then, just losing it all. And these people, this goes back to the idea we were just talking about, where somebody bought at $200 thinking this was going up, and now it's down to 100, and they're getting hurt, or they're buying something like a short and then really getting hurt because they don't understand what that is. And I think it's easy to sit back in armchair and point and say this stuff is irrational, and there's probably some argument to be made there. I don't want to trivialize that kind of argument, but there's a lot of, and I think an increasing amount of actually argument in economics related to this idea of people are willing to risk things that are in sort of like a lottery scenario, right? Where I'm willing to lose, if the upside is winning super big, because there's this added benefit of playing the stock market well. I tell my students this in class. If I'm an economist and I tell people that, and they say, oh, okay, so what's the stock market going to do? It's like, that's not what economics is. So my personal investing strategy, which you and I have talked about a couple times, I think on here, is this very simple Warren Buffett type of idea. I put it in large cap funds with low cost and let the economy do the work. I sort of figure, if it's going to improve, then I'm going to win. And if it's not, we got a different set of problems, right? So that's my reasoning here. But a lot of people want they want that extra benefit of trading and playing in the stock market and winning, because now I'm brilliant, right? This GameStop thing happened and I saw it and the stock started going up, and I went, oh, I got it, I bought, and then I made $100, off my $1,000 that I put in there. There's this extra benefit of gambling and winning, and I think maybe some people are okay with losing some money doing that. So I think we shouldn't be so quick to ascribe everything to irrational. I'm not saying that's what you were saying, but there is that narrative out there.
I mean, I personally, when students ask me about, do you invest in the stock market or do you play the stock market? My general favorite answer is, honestly, I prefer to go to Vegas where, I can maybe get a few free drinks out of it and see a show.
Yeah.
Because I don't know what's going to happen in the stock market. I don't know what's going to happen at the blackjack table either.
Yeah.
So, at least I can have fun playing blackjack in Las Vegas.
Yeah.
As opposed to, or at least pre-COVID, I could, right? Yeah. As opposed to sitting on my computer and watching a number go up and down and thinking, when's it really going to skyrocket? Yeah.
I'm saying there's extra benefit that people are getting from playing. They might actually prefer that. They might rather be trying to figure out where GameStop is going than trying to figure out what's going to happen in the blackjack game.
here's another kind of fun narrative on this: is you've got a lot of people now staying home from COVID. How are you going to get your kicks? You're sitting on the computer, you're playing video games.
That's a really good point.
You know what? Maybe day trade.
That's a really good point. That's a really good point. Okay, so let's get to the moment everybody's been waiting for. We have a benign reason. We have an animal spirits, trading curve, circuit breaker reason. We have regulatory threat, which is what all the economists got excited about. And now everybody who messaged me and said, you got to do an episode about this. They want the nefarious story. They want the dark backroom, smoke-filled, everybody smoking their cigars and chuckling with their monocle in their eye. Give us the nefarious version of the story and maybe assess it a little bit too.
So the nefarious version of this story is we have the clearinghouse, the DTCC does a whole lot of business with these hedge funds and these larger firms. And maybe they get a call from these people who usually put down their collateral and make these trades. And, isn't it great that we use you as a clearinghouse? So then the hedge funds call in a favor to DTCC and tell them, well, look, the national clearinghouse that's supposed to be making these trades is apparently going to be making this huge trade with them. Can you stall it? And the point behind this stalling and this conspiracy theory is that you have hedge funds like Melvin Capital, who have got this short position on GameStop, and if the price stays high, they lose a lot of money. I mean, we're talking about going from 12 billion in assets to 8 billion in assets, so a $4 billion loss in their short positions on GameStop. So of course, they have incentive to jump in on it and try and convince the clearinghouse to slow things down so that the institutional investors can get their money before the retail investors know what's going on. And I'll add the other conspiracy theory on this, because some people aren't convinced that the retail investors are large enough to cause these market movements, that there are other hedge funds competing with Melvin Capital who wants to get involved because they're seeing this point where they can possibly hurt Melvin Capital to their advantage. So then they're also getting involved with DTCC, saying, look, these retail investors, we can't let them come in and make things more volatile. We want to ride this all the way. So we want first dibs on those shares. Slow down your retail investors so that we can get to it first. And that's the conspiracy theory here of, the back room and the smoking cigars, both from, hey, Melvin Capital may want to slow things down, to Melvin Capital's competitors who also could be price makers in this particular market are getting involved behind the scenes to take up market share. I mean, one of the big winners of the Great Recession was Goldman Sachs, because they got rid of Bear Stearns and Lehman Brothers in a stroke, right? I mean, there's the conspiracy theory for you all.
So the reason that this appeals is because things like RobinHood stopping buying, but not stopping selling, which is why I wanted to make that point clear early on, really fit. I mean, that just got to eat you up if you're involved in this thing. So you stopped the purchases so the price can't go up, but you allowed the sell. So you basically forced the price to go back down to bail out the short sell.
Oh, that would be in the facts of the matter. I mean, what they did obviously and definitely led to price going down. There's no question. Yeah.
So we live in a time in a world of conspiracy theory, and so academics like us always want to try to make sure that we're standing on that firm ground. And as a general point about conspiracy theories, is often in the intermediate parts of the conspiracy theory can look right and probabilistically be right, but the chain of things that have to be right then multiply those probabilities together, and suddenly a conspiracy theory gets very unlikely. But there's only two links in this chain, seemingly. And so it seems like a likely story. I'm not trying to tie you down to a position, because we know we're only halfway through the story. A lot of things are going to come out in the next week or 2 weeks, and we want to make a podcast. We want to make sure Dr. Mattson looks good when this all shakes out. So I'm not trying to tie you down to a position, but do you have just any comments that you'd make there?
Well, I think And I'll be honest, I've got a lot of sympathy for the conspiracy theory, because I personally would like to see a lot more. I would like to see more retail investing. I would like to see people jump in, because I feel that that's efficiency improving. Yes, there are risks, but just like, so long as everyone understands, when they're walking into a casino, they can walk out with nothing. When you're walking into the stock market, you can walk away with nothing.
Yeah,
I
don't
think
gamble
that,
with money you can't bear to lose, right?
don't and don't short.
Don't short. Yeah, don't gamble with your
Yeah.
kids' college
Oh, yeah.
education.
Um, so I think, with the general narratives that we've put through, I honestly, if I'm going to be an economist who cops out and does the whole on one hand this on, I'm going to go with all of the above at this point. I think that there's two links in that chain, and I see a definite incentive for other hedge funds to get involved to the detriment of Melvin Capital. I see incentive for Melvin Capital to get involved to try and protect itself. I do see that Robinhood could come into problems with that collateralization. So how much you think that mechanical story actually matters is one thing. It looks really bad that they allowed buys but not sells, and especially right at that time, at that exact moment. Why not 3 days before that? Why not 2 days after that? So there's a lot going on, and I think the thing about conspiracy theories is they simplify.
Yeah,
it really does make your it's evil capitalists. This goes back to the explanations, the narratives behind the Great Recession and the financial crisis of 2007. It was all greedy bankers, right? Except it wasn't. Except it was a lot of things coming to a head, at that exact moment, and the story is much more complicated. But it really saves time to just talk about either a bunch of crazy Redditors or a bunch of greedy hedge funds, or a bunch of regulatory agents trying to grab at power. And I think there's probably a combination of all of them, and maybe even none of them at the same time. It's a complex issue.
And maybe things that we haven't even observed, because I think we have laid out a really nice framework for understanding the narrative. So what I want to do now is kind of take this to the macro world, give me like a broader understanding of the different kind of markets involved, and like what's the monetary approach here.
Sure. So this is the part of the podcast I think everyone enjoys, where I will once again blame everything on the Fed.
This is our special section that happens only in the episodes that feature Dr. Mattson, right?
So from a macroeconomic perspective, what we want to do is we want to separate out what these stocks do for us, or what other things that are booming in price do for us, like cryptocurrency or equities. You can separate out these kinds of finance industries, at least for me in a macro term, into three specific markets. A money market, where you can think of cash, checking accounts, savings accounts, very, very safe, very liquid. You're not going to get rich off of them, but you're not going to lose to inflation, right? That's great. And then you have these capital markets. You think of bonds, and that's a lot less liquid, right? I mean, you can't really unload 10-year treasury bonds very quickly. But you have these capital markets where you can kind of build up certain assets. You can maybe even throw in property into this, and look at mortgage-backed securities or things like that. These capital markets that we have that are nice. And then we have, so money, capital, and those two kind of feed on each other, because you use the money to purchase the capital, and you can sell the capital in order to get the money. And they have a medium of exchange service and a store of value service. So there's money, right? The three things of money: medium of exchange, store of value, unit of account. But then there's a fourth potential service of all money, and that's speculation. So then we have a speculative market that's very liquid. You can sell equities, for example, very, very quickly if you need to. It's risky. Let's not kid ourselves. Equities are risky. Companies can go out of business and stocks can go to zero. If you short, then you can go below zero, which is why we don't short. So what does GameStop give us? Are we investing for the long run in GameStop because we really believe in the retail video market? No, not really. What we believe in is we believe in this speculation, and that's the service that it's providing. Now, why? How do I blame the Fed in this? Well, The Fed will get into the money markets to stimulate the economy in times like a global pandemic, financial crisis, or recession. That's going to drop interest rates down, and that will bleed into capital markets,
Yes.
bonds. Bonds returns will start to go down. But you know what? There are not just the store of value investors in bond markets, there are speculators. There are people running retirement accounts and pension funds that are trying to figure out how to get the best, 3 to 4% return for their clients. And if the bond markets are giving you 0 or 1, where do you go? So then you have, again, these very smart pension and retirement people who are then looking at the more speculative markets like equities and saying, well, the stock market keeps going up. 2020 was a bad year economically, but for the stock market, 2020 was pretty good, actually. My retirement account did really well in 2020. I'm fairly certain yours did too, especially if you were buying a broad sense. So we need this kind of speculative management going on to give us this return, especially if the Federal Reserve is driving interest rates below 0. So we've whet the appetite for these investors who are responding to a price signal. And this is where I'll deviate from maybe Shiller's irrational exuberance and call it a rational exuberance. We have investors.
Let me pause you there just a little bit. So for our listeners, they're going to go, what's irrational exuberance, and why is Dr. Mattson so keen on calling it rational exuberance?
So irrational exuberance would refer to, with Dr. Shiller's work, Nobel Prize winning work, by the way, of bubbles and asset values being based on nothing but price forecasts or price estimates. So you see GameStop is going up, up, up. You don't know anything else about GameStop, but you know it's going up, so you think it's going to keep going up, and you buy in. And that's irrational because you're not looking at the fundamentals of things. You're not making a full information decision on the risks, and you're letting your animal spirits and your exuberance kind of take over. This actually was based off of a phrase by Alan Greenspan, and that's where they got that, where Greenspan was talking about stocks in the mid to late 90s, talking about irrational exuberance. Because like most Federal Reserve Chairman, Greenspan didn't want to spook markets. Yeah. So he gave a phrase that, sounds really technical at first. And then when you deep dive into it, irrational exuberance is just people are going crazy. People are jumping in. They're afraid of missing out, so they're jumping on the bandwagon. I'm going to argue that this is rational because I think they are responding to a price change, not just the not the nominal stock value they're seeing, but a price change in other markets such as bonds or other returns that they can't get a lot of return from.
That's a brilliant point. So you're getting at this idea that we can't just evaluate what's happening in these speculative markets without also thinking about what the alternative options are. And I make this argument a lot in my graduate classes when we're talking about unconventional monetary policies. This has real consequences because it's taking away the normal options of investment that people would want to be in, and therefore it causes them to get into these other things, which has that kind of irrational or rational exuberance idea.
So what we're now seeing is people have this appetite for day trading when they wouldn't normally have had that. And not just the greedy institutional investors or the crazy memeified Redditor retail investors, but smart people looking at their portfolios in the future and thinking, well, the return on bonds is low. The return on cash and money is not all that different either. Where do I find this return? And that's where equities provide that. And this is why you see, the stock market going up and up and up in 2020, a lot of that has to do with this, demand curve going out and out and more people wanting more and more stocks. And if demand goes up, price is going to rise. So the Fed is feeding this sentiment. Retail investors who are on Reddit, like, and pardon my French, but here we go. You have Deep Fucking Value, who last year, I guess, is the guy who found this. So what Deep Fucking Value was able to identify, much like Burry in The Big Short, was that these stocks in GME were he figured they weren't priced correctly. and he reported it and put it out there, and people were going back and forth saying, no, this is wrong or this is right. He saw this, but would you, in another world where you have, I don't know, a 4% return on a 10-year treasury, would you have the deep fucking values of the world decide that they're going to go in the bond market and then, go back to work wherever they are, and not pay attention because they know that the bond market is going to give them this nice, fairly regular return? Or even then you have, let's say deep fucking value is working at, your typical hedge fund. He's making up a portfolio and he's thinking, well, gee, this looks a little risky. I'm gonna go to the alternative. Where else is he gonna go? We've created this environment since 2009 where we have a zero lower bound on interest rates for bonds, for cash. I was teaching my money in banking class the other day and showing them the real return of cash and the 3-month treasury bill. They're equivalent. You can either hold on to $500 in $100 bills, or you can hold on to $500 in a 3-month treasury, and you'll get the same value from it. So then, you get that stimulus check from the government, and you think to yourself, well, I don't know what to spend it on because I'm home all day, because we're all doing social distancing and being responsible as we should be, right? Okay, great. Don't go to the bar and drink it. Great, fantastic. So what do you do with it? Well, I guess I'll day trade. The Federal Reserve, through what they've done with this kind of money pump action that they've been doing, and you and I keep talking about this debt monetization that they keep doing is
shameless plug for a future episode right there.
Yeah. It's providing this kind of flat landscape for returns that is incentivizing people to look elsewhere. I mean, you can get returns from the art market. In the late 90s, you could get returns from comic books, right? People were betting on baseball cards. All of these things that weren't your traditional investments, because the traditional investments just aren't giving the return.
So that brings up two really important things, and I'm gonna take us back to that idea that I brought up at first, which is strike one for free markets, which is it doesn't seem like a free market process, and you said, well, I don't think so. Let me make the case for that now. So the hedge fund got their hand in a cookie jar, engaged in what seems to be what's the word that's people always like to use, the downside value of which is apparently a loss of $4 billion, right? Yeah. And they got their hand in the cookie jar, engaged in what seems, to me, I'm always thinking about diversification, what seems to be a bad strategy, or if it's not a bad strategy, at least an exploitable strategy. And deep fucking value comes along and says, actually, I can capitalize on this. I can punish this behavior. I can benefit from it. And I say, if that person, you had mentioned before we started recording, what kind of gains 45,000 turns into 45 million or whatever that number is. I say good for him. Strike one for the free market, because there's a behavior there that's exploitable. And now I think if Melvin survives, at least other hedge funds that are going to survive, maybe they learn a lesson here, and maybe there's less of that type of behavior if it is exploitable, right? And I'm not really taking a position. You've said, hey, we shouldn't be engaged in shorts. I'm gonna leave that for another conversation.
I shouldn't be engaged in shorts.
not that
let me
nobody
clarify
should.
For me.
That's an important clarification.
So
where am I wrong? Where am I wrong? Strike one for free markets.
So all right. So here we go. And this will harken back, I think, to your fantastic podcast with Dr. Bartel on monopolies. So in our money markets, we have a very clear monopolist on money supply, the Federal Reserve. They release the amount of money that the Treasury prints up, or they choose not to release that. They are the ones that do that. Now, so that's not competitive. Monetary base, cash reserves, that's not competitive. On the other hand, inside money that's generated within the banking system is competitive, because Amarillo National Bank can create a certain amount of checking accounts and monetary service through that. And they compete with Bank of America for those depositors, who competes with Citibank, et cetera, et cetera. And we can make all kinds of arguments about whether or not bank concentration seems more monopolistic today than it did 20 years ago. But let's go ahead and say it's competitive. So we have that inside money market that is now competitive. We can go to capital markets. We can start talking about mortgage securities and bonds, commercial paper, and we can say that seems very competitive. We can go to equities then. Now, here's the question. This is, I think, where Melvin Capital was actually engaging in some very anti-free market activity, because Melvin Capital probably figured that they could control this price. They figured that not only could they guess where it's going to be, but they could funnel it in a certain direction. And you can see interviews. I think Jim Cramer on CNBC has an interview where he talks about how, back when he was short selling, there were certain strategies that you engaged in with what you released to CNN or Fox News or CNBC on information on the stock price, which you can't quite do with Reddit, because Reddit is now very much open. It could be someone telling the truth. It could be a bot, but there's this open information everywhere in Reddit that they're, all these information signals that are now competing for your attention. So what deep fucking value then does is posts this information, and that can generate all of these little retail investors. I mean, this is like that, death by 1,000 cuts thing. Or, what was it, Gulliver's Travels, where he's got the little, they're not brownies, but they're, maybe I think in the movie Willow or whatever, but okay. So, when you've got a whole lot of little warriors attacking one giant, at some point, if you have enough of those little guys, the giant's going to fall, right? Yep. So what Melvin Capital probably underestimated was the amount of the investment that could come in from the retail investors, the amount of buying that could come from retail investors, probably also the buying from other hedge funds that want to get back at them as well. And they figured they were a price maker. And when you think you're a monopolist, you're going to behave as a price maker, right? I mean, we in economics, we have the perfectly competitive markets, price takers. I can't compete with my neighbor on price because, he'll undercut me or I'll undercut him. And so we reach that equilibrium, the magical X, right?
Yep.
And we move towards that. There's pressure for that. Melvin probably thought that they didn't have that pressure. And when you get a bunch of, when the cat's out of the bag and there's all this information about, it's probably, it might be worth more, or, now we've got this rational exuberance going on and people are buying and holding. You had these massive amounts of posts on Wall Street Bets, for example, talking about, okay, we're going to go back to deep fucking values analysis and everyone hold, buy and hold, buy and hold, buy and hold. Melvin probably figured at some point they're going to break. And at some point they have, or they will, as it's just at some point it's going to come down, right? And then people will sell. That's fine. I think, in terms of free markets, I think the shorting positions were done very much with not free market, but almost price making anti-market strategy. And the market reaction of the retail investors is something that could potentially correct that monopolistic move by these hedge funds. Now, this is where the other conversation you and I have a lot about regulation comes in, because when the regulators come in, and I know Dr. Piesky, you and I have talked about this before, I think with you guys are saying if people are going to regulate this, or if Janet Yellen at Treasury or Jerome Powell at the Fed is going to come in and regulate, I'm saying when. I do think it's a foregone conclusion that the Federal Reserve and the Treasury are going to step in and work on this. When they impose those regulations, is that going to create more market power or less market power for these hedge funds? And my bet is it's going to create more.
Yes.
Which we can get into that. But that also depends on what the story is coming out of this. That depends on the narrative that we're going to tell about it.
Yeah. So, one of the things that we try to teach a lot in economics is competition disciplines a market. Like a market produces its own regulatory forces. Now there's sometimes that those fail, right? And that's where econ gets interesting a lot of times. But there's a reason that there's no need for us to regulate what kind of leather goes into our shoes because the market competition forces that kind of discipline onto the market. And my point is, strike one for the free markets is this kind of argument that you made. Here's an anti-market behavior, and here's a market reaction where they got caught trying to do something that maybe they shouldn't have. Not that I'm hailing Wall Street bets or deep fucking value as heroes or anything like that. I'm just saying, but for every force that's trying to push one way, if you have forces that push the other way, that's the fundamental process of a market.
Here's that difference in narrative, because if I go on Reddit and I look at Wall Street bets, I see everyone saying, you know, in terms of people looking at the markets, they're talking about, you know, free markets being Melvin Capital as a hedge fund. And then, you know, the Redditors and deep fucking value being the people who are going against this, I guess, or going against it as populist or anti-capitalist. And I think you and I see that very differently.
Yes.
I will continue to argue very strongly that what Melvin Capital is doing is very much anti-market. They're behaving like a price maker. But I don't think that's the narrative that most people who are engaging online are telling about this.
Well, I think there's two things there, right? I think there is this idea that some of this monopoly behavior and anything business must be capitalist, or anything business must be free markets. And that's one thing you and I have to fight against a lot, which is, no, free markets is where we don't have the market power. We don't have the regulatory intervention, and people making their own choices and engaging in exchange, you know, leads to the kind of allocations that should be happening. And part of that is an absence of market setting, price setting power, which is to say, I think there's also another version of I think there is that version of Wall Street bets is against business, so therefore it's like anti-capitalist or something like that. And I think that's pretty obviously wrong. But the other version of this story, right, almost comes from the other side, is, well, they're engaged in market manipulation. But I don't see how Wall Street bets or deep fucking, I don't see how those people did anything that could be counted as manipulation.
They didn't. I mean, you know, if I go up and I post on some bulletin board, you know, down here in West Texas A&M that, I don't know, GE is overvalued and I post it on the board, am I engaging in market manipulation? No, I'm putting out I'm putting out some kind of information signal.
Yes.
That people can make what they want with it. When deep fucking value first posted, and you can find this post back, I want to say it was even back in 2020 when he started, you see a lot of people, you can set reminders in Reddit, right? There's one guy who said, set reminder for when this idiot loses all his money.
Yeah.
And that reminder, I think, finally went off 4 days ago. So, you know, who's laughing now? The guy who put 56,000 into GME and got 48 million, or the idiot commenter who's like, I'm going to laugh at him in a few months.
So I want to come around to another idea here really quickly, but when I had remembered back on Friday, this is changing so fast. So these kind of things are difficult to keep track of. I had remembered somebody talking about him saying, you know, he was in for this and he was up to $1 million and he hadn't gotten out. And so that's a sign that he really is, you know, fighting the man, sticking it to the capitalists and whatnot. And so when you say he's turned it into 48 million, I'm always curious. And I don't think we may or may not be able to know this, right? Has he actually gotten out and then like turned that into some value that isn't held in GameStop stock?
Sure. I mean, that's a good question. I mean, I would have sold.
But, I was going to say, if you started with $45,000 and at close of business on Friday or whatever, you were worth $1 million.
That's armchair quarterbacking, right? I mean, you know, this guy went in and did the homework and he can do whatever the heck he wants with it.
Yeah, for sure.
And he chose to share that information. Yeah. And that information, I mean, it's very, I'm sorry, for lack of a better term, it's very democratic. I mean, it's very transparent. Everyone knows this. If this had been, you know, Martha Stewart spent time in prison for insider trading.
Like the opposite of that.
We can certainly do a podcast on that because I have strong feelings that, I mean, she should not have been in jail. I mean, come on, guys, really? Martha Stewart, but on the other hand, it gave us all those Martha Stewart Snoop Dogg specials, which are fantastic.
Right. So let me present, since we're on the topic of narratives, let me present an alternative narrative there, right? So there is this idea that people can sort of go about that self-reinforcing idea where I get some renown. I build up a newsletter, say, and I send it out and I say, this price is going to go up, and I have a big enough readership that they buy, the price naturally goes up, but because I'm sort of the tip of the spear, I can get out first and win. And I've really just kind of suckered my own people, and that becomes self-reinforcing, because then I can say, look, I told you GameStop was going up. I bought it. I made $48 million off of it. And you guys, you just didn't believe me. You got in too slow. But it's actually in part that I made money off of those people. So there's always that concern here.
There is that concern.
Comment on that as like an alternative narrative to your democratic narrative.
So if from that narrative, which I'm going to bet is going to be the narrative coming out of Treasury and FDIC and the Fed and other regulators, not FDIC, excuse me, SEC and the Fed, that there's the potential for manipulating this stock. And that narrative then is going to lead to regulation where we need to protect the investor from himself, because they're not smart enough to realize that deep fucking value may not, he may be manipulating the stock market at this point. So really what we should have, and this is my concern, I guess, and what we really should have is, licenses for traders. Maybe we shouldn't have people day trading on their apps. Maybe they should all go to licensed certified financial accountant or certified financial planner, pay the premium, and those are the guys who are going to make those sales because they're responsible. They don't get their information from Reddit. They get their information from their college degrees and these data sets and the firms that they work for. And that to me is going to, that to me is anti-market at that point.
Yes.
Because what that is going to do is give even more power to these hedge funds, these financial firms in setting that price. Because these people giving this advice, we're going to go right back to that of, hey, we think GameStop is going to do this and that, and you should invest that way. And oh, by the way, we work for Melvin Capital, who will, as another part of their corporation, start shorting it. Lehman Brothers did this. Lehman Brothers, when they had to be unwound, what a lot of the regulators who went in found was that Lehman Brothers had, dozens of these different smaller corporations within the giant umbrella entity. And you'd have, I don't know, Mattson and Stitzel, really safe trades. And we'd be giving information to our clients and say, yeah, you guys, to avoid these problems, this stock is going down or this stock is going up. And then they'd share information, or maybe just even be Stitzel and Mattson really risky trades.
Yeah.
And they'd start shorting on that information or betting on that information going in. The thing that is so free market and capitalist about Reddit is that the information is just out there. Now, granted, they could be bots, they could be fraudsters, or they could be just individual people sharing what information they have. And there's no charge for it. But I can definitely see where the regulators are going to want to come in and do something about this. And that's the narrative they're going to take of Reddit can manipulate.
So let me jump in here, because this is one of those ideas that I'm pretty fond of talking about. And I think it's never made it to the podcast before. So I'm glad you're kind of giving me the opportunity here. This is what I call ghost stories. Right? Which is nothing actually happened, or yet maybe. And we say, well, here's this version of the story that can go all the way out, and Reddit is out there, and there's a bot, and he puts information out there, and then everybody buys in, and we get this GameStop bubble thing, and then it bursts, and your brother-in-law loses his shirt, right? And so we need to step in, and we need to create regulation that's going to certify, and it's this pursuit of safety that has become just such an absolute cudgel in the hands of people that want to wield these ghost stories in favor of regulation. When you and I then would sit back and point out, right, and when this regulation happens, who benefits? Is it the retail investors? The answer must by necessity be no, because how does the regulation get formed? It gets formed in a system that promotes this centralization of things, and then the type of stories like you're telling about Lehman Brothers can happen. So I would say it's absolutely imperative that we don't allow the ghost stories of your own agency used against you, right? I mean, your agency is in your own choice here, being used against you. Your brother-in-law ends up losing his shirt. And I'm not trying to trivialize those type of things that seem likely to happen here in the next 2 weeks. And some of that where the guy that we're saying is leading this spear, does he turn out to be a good guy or a bad guy? Very difficult to tell, and that's why we wanted to make this narrative story. But I would say one of the other common types of narratives is what I'm going to call ghost stories. Is here's this emergent behavior on Wall Street bets that then led to all these bad outcomes, and we need regulation, when you and I can just as easily say, right, and here's the ghost story in reverse. That happens, and now we have Stitzel and Mattson safe bets that feeds information to Mattson and Stitzel risky bets, and you also lose. Yeah. Wouldn't you rather lose making your own decisions? That's the importance of avoiding the ghost stories. Well, so then comment on that before I get us to one last topic.
Sure. Let's talk about, some of the other, let me tell you another ghost story. So we talked about, I think we mentioned a bit about the flash crash, right?
Yeah.
With the flash crash in 2010, and at the end of a 5-year investigation, the SEC makes one arrest. They arrest a London, and described in the press as a point-and-click investor, living with his parents.
A retail investor.
Yeah, a retail investor as the guy who somehow started the snowball turning into an avalanche that became the flash crash of $1 trillion loss in May of 2010. And this guy gets arrested, and everyone's like, oh, it's one of these, retail investor guys who's, I don't know, anti-social or not, charismatic. And he's like, making these algorithms and pointing and clicking. And so because of that, we then have to regulate the algorithmic trading. And they did impose regulations on this algorithmic trading, which, it may or may not have actually, been a cause of this. It may or may not have improved things or not. People complain about, the New York Stock Exchange now has a bunch of computers instead of guys doing the whole, buy-sell signal. Fine. We can go to the ghost story of 2008. Societe Generale lost billions of dollars in a day. And again, one arrest made of this one guy. And somehow this one guy is one of the main contributors, not the bank itself, not, the larger financial institutions, not the endemic uncertainty in 2008 financial markets, just in general. No. We want, these guys, and then we're going to put up a Volcker rule about leverage. And I like Volcker rules, but let me just go ahead and say, that ghost story helps bring that about. Or let's go to long-term capital management. Back in the late 1990s, these guys supposedly were, these great investors, and they had to be bailed out. Long-term capital management potentially, at least according to the story, led to all this instability in the market. Probably was more of the instability in the market led to the demise of long-term capital management. But again, you can look that up and you can find a different story. Or let's just go to 1929. All those greedy bankers and retail investors making all those irresponsible bets. And you know what? What's the story someone told of, when the guy who's shining your shoes is talking about the stock market, that's when things are going to go wrong.
Yeah.
Well, that to me is I mean, I can see the logic behind it and why does he understand the risk involved? But at the same time, that's a really arrogant statement.
Yes.
And this guy being involved in it, does that say more about, the risk inherent in the stock market, or more about the fact that he's just not getting anything from his bank and has to go somewhere else to find that return? If we're going to consistently push these people out of money markets and capital markets into speculative markets and assets, and drive up Bitcoin and GameStop and Dogecoin or whatever other things that we want to do, maybe we should look to what we're doing in bond markets and try and deal with that as well. But I definitely see a point where the SEC and the Federal Reserve are going to want to put some kind of curb on retail investing, because they're going to see that as a source of instability, and that's caused by this ghost story, or maybe not caused by it. they're going to use this ghost story narrative to justify it before Congress, and Congress will make these new laws, which, hey, you know, as a PhD in economics, that's probably good for me, because then the Fed will need to hire more PhD economists, and that drives my wages up, right? So maybe I should be happy about all this.
But the listener shouldn't be.
Yeah.
Okay, so you've actually set us up perfectly to go into my next idea. So I want to wrap this whole thing together with this one idea. So you've laid out the Fed is engaged in these behaviors, and it's squashing these normal forms of return that we would like to engage in our investing, right? That whole money is a service idea, and we want to move consumption through time and space, right?
Mm-hmm.
And so one of the concerns I think that stems from this is this idea that the way that we have financialized and the way that we have made you search for yield in riskier and riskier and riskier places has caused sort of an unnecessary entanglement between everyday business on Main Street and what's got to be happening on Wall Street. So close us out here with just like a little bit of commentary on how the real economy, if you will, is being further sucked into this financial intermediation that's happening, and sort of the consequences of that.
Yeah, retirement funds is the first thing I can think of. You know, you work and, you know, you put a certain amount of money into your 401k, and, you know, on top of that, you know, firms can justify a little bit lower wages by offering you that wage match. If you put in, you know, 3,000 such and such amount, we'll put in, I don't know, 2,800, right? They'll match it, and that artificially depresses some of these wages. I mean, you're not really depresses, but you know what I mean, right? It's not, you're not getting the paycheck, but you are getting that benefit. That can also lead to certain amounts of instability in you know, whether or not people think they can retire. You know, I look at these markets and I'm like, oh, well, you know, I'm going to retire at when Social Security kick in, 65, right?
So yeah.
And you know, okay, well, but then again, I'm a professor. I can do this until I'm 80 if I want. And I look at the stock market and think, hey, the stock market's doing well, but there's a whole lot of exuberance. So I'm concerned what's going to happen. I may just keep working until I'm 70 or 75. And then that creates, you know, this issue with labor markets of, you know, I'm not making way for another younger professor to come in and step up. I'm taking this job, but then we can also argue that maybe I'm looking at too much from a zero-sum game point of view on that. We've tied up retirement accounts, certain amounts of wages. We can do stock options with wages as well, right? That deals with whether or not people are making a certain amount of wages. We can tie in where these firms are getting money to expand. They've got to go to a bank, and they're facing, you know, a certain amount of interest. And they may, you know, it's going to be, the bank may not be able to offer all that much, or they may not be able to charge all that much in interest, which is good for the firm, but not so good for the bank that maybe wants to get that return. So where does the bank go for its return? It goes into the equities markets. You know, in 2008, we had all this problem of, you know, certain banks were getting into investments they probably shouldn't, which were not insured by the FDIC, and making these banks more unstable than they actually looked on paper. Again, where else are they going to go if interest rates are this low? Yes, it's good that firms, hey, can expand, but then the bank that's offering that interest rate may not, you know, then they look for other things. Fees, maybe they'll decide, you know, we just won't loan based on certain characteristics to make up for the fact that we're not making as much in interest rate prices. We are very much tied to what's going on in finance, because finance is kind of the plumbing of the economy. It allows for firms to expand by generating these loans. It allows for brick and mortar to be built. But if the plumbing doesn't work, if you don't get water to the proper places where you need water, then it's just not going to grow as well. Right now, you can go out and find funding. It's, you know, you can get it. Even during the global pandemic, you can get it. In 2007, 2008, with the liquidity freeze, you couldn't find funding for anything. So if we have this increasing instability in the financial market, increasing instability of banks, and then banks, closing down because they're making investments they quote unquote shouldn't, that can lead to real effects. That can lead to real increases in unemployment based on a financial crisis, which is what we saw in the Great Recession. It could lead to people not being able to afford housing. It could, because the mortgage, right now, mortgage interest is very, very low, which is good, but then housing prices are now very high, which, is the trade-off there.
Yeah.
But yeah, it's part of our economy that we do need to pay a lot of attention to, even things like this. I wouldn't worry about things like GameStop crashing the economy. That's never going to happen. GameStop can't even crash the stock market. You look at the overall trends in the stock market, and GameStop is down, the S&P is up, GameStop is up, the S&P. There's no endemic problem with GameStop in particular, but the problem could come in with the instability, and then also you can get irrational exuberance downward. You can get people getting really afraid of the stock market and pulling out, and that demand contraction is going to lead to prices going down in the stock market, much less return, and those pension funds and those 401ks losing value.
My guest today has been Dr. Ryan Mattson. Ryan, thanks for joining us on the EconBuff.
Thanks very much.
Thank you for listening to this episode of the EconBuff. You can find all previous episodes on YouTube at EconBuff Podcast. You can check out our website at econbuffpodcast.wixsite.com. That's WIXSIT.com. You can contact us at econbuffpodcast@yahoo.com.